Here's the brutal truth that will save your trading career. Most traders don't lose because they pick bad stocks. They lose because they double down at exactly the wrong time and freeze when they should act. The market punishes poor position sizing more ruthlessly than poor analysis. This isn't about your ability to spot patterns or read charts. It's about your discipline to sequence your capital deployment correctly. Amateurs add because they feel desperate, their emotions hijacking their original plan. Professionals add because the tape confirms strength. Their additions earned through market validation rather than hope. If you felt smart about your picks but still bled cash, this is why. Your edge isn't prediction, it's sequencing. When you size, when you stop, when you wait, you've been there. Your position moves against you, and that voice whispers, just average down, lower your cost basis. It has to bounce back. This is the siren song that destroys accounts. The fire, rationalization that transforms manageable losses into catastrophic drawdowns. The mathematics are unforgiving when you fight the tape with additional capital. Every dollar you add to a losing position compounds your exposure to being wrong. Yet this is exactly what 80% of retail traders do when faced with their first taste of adversity. Consider two traders buying the same breakout at $50. Both have done their homework. Both see the same technical setup. A clean pivot after weeks of consolidation, volume building on the approach to resistance. Both are convinced this is the moment. But their execution tells two completely different stories about risk management and psychological control. The amateur goes full size immediately, 1,000 shares at $50.05. He's been waiting for this setup for days, maybe weeks. FOMO drives his decision. I can't miss this move, he thinks. The breakout is happening now. Price fades to $49.20, which is completely normal. Pullback noise after any breakout attempt. Most stocks don't go straight up. They test, they consolidate, they shake out weak hands before making their real move. But the amateur doesn't see normal market behavior. He sees his profit and loss statement turning red. He sees his conviction crumbling. Panic sets in. The voice of desperation whispers again, just average down. Lower your cost basis. It has to bounce back. So he doubles down with another 1,000 shares at $49.20, with a roundest takers to a 7, telling himself he's getting even faster and buying the dip. His average cost is now $49.63 across 2,000 shares. He's committed twice his original risk to the same idea, but now at a much more precarious technical level. The stock continues to weaken, breaking below the pivot point entirely. It drops to $47. He's down $4,850 on what should have been an $850 loss. With proper risk management, his account is wounded, his confidence shattered, his capital depleted for future opportunities. The professional, she bought 500 shares at $50.10, with a stop at $49.40 right below the technical structure that would invalidate her thesis. When price faded to $49.20, she didn't panic. She didn't add. She waited. This is the critical difference. Patience during uncertainty. She understood that normal market noise doesn't require action, it requires observation. Only when price reclaimed $50.80 with expanding volume, clear evidence that demand was overwhelming supply, did she add the second 500 shares. Same idea, completely different sequence, radically different outcome. Her average cost across 1,000 shares became $50.45. But more importantly, she had earned the right to that full position through market confirmation. This is the 1/2 rule. Start with half your intended size at the pivotal point. Earn the right to add the other half through market confirmation, and freeze when uncertainty creeps in. Your edge isn't prediction, it's sequencing. The market doesn't care about your analysis. It cares about your execution. When you size, when you stop, when you wait, these timing decisions determine whether you survive and thrive or join the statistics of failed traders. Here's the identity test that separates amateurs from professionals. The amateur asks, "How can I be right faster?" The professional asks, "How can I be wrong cheaper?" One hunts for certainty in an uncertain game. The other builds a process that survives uncertainty. One widens, stops, and adds on dips to soothe fear. The other keeps stops where the idea fails structurally, and only adds when the tape confirms. The market hears your questions. It pays the humble and taxes the proud. Let's quantify this approach. Suppose your account is $100,000, and you risk 1% per trade. 1R equals $1,000. The amateur slams full size into the first entry, risks 2R without realizing it, then doubles down, ballooning exposure to 4R. A routine 10% swing now threatens $4,000, 4% of the entire account, on a single idea. Meanwhile, the professional starts with half size, 0, 5, R. If the tape confirms, she adds the second 0, 5 R. If the idea fails at the stop, she loses 0, 5 R and walks away clean. Small wounds heal quickly. Amputations destroy careers. The pivotal point is where opinion meets evidence. It's the hinge of the campaign, where a base resolves, where a downtrend exhausts, where volume swells and the tape speaks clearly rather than in whispers. Professionals wait for that hinge. They don't anticipate it with oversized bets. They post a half position at the moment of clarity, then let the market prove the rest. Waiting is a position. Patience is risk management. You win by buying time, not by buying more shares into uncertainty. Consider Marcus trading a biotech breakout at $38. He plans 800 shares total, his full intended size based on his risk parameters. The level is $38.20. Tested 3 times over 2 weeks. He enters 400 shares at $38.25. Stop at $37.60 below the structural support that validates his thesis. Price pokes to $38.70, then snaps back toward $38.10. Amateur Marcus would add, to protect the average, or because it's cheaper now. Professional Marcus freezes. On the next push, volume surges, $39.10 prints with conviction, and the breakout gains momentum. Only then does he layer the second 400 shares. If that second push had failed, he would have taken the 0, 5R loss and preserved capital for the next clear setup. The psychology behind this approach runs deeper than simple risk management. When you start with half size, you reduce the emotional intensity of normal market fluctuations. A $500 unrealized loss feels manageable. A $2,000 unrealized loss on the same percentage move creates stress that clouds judgment. Stress leads to poor decisions. Poor decisions compound into account-damaging mistakes. The 1/2 rule breaks this destructive cycle by keeping your initial risk within your emotional comfort zone, while preserving the opportunity to scale into strength. Think about stop losses. The amateur treats them like suggestions. He nudges them lower, bargains with the screen, and calls it flexibility. The professional treats the stop as the place where the idea is proven wrong structurally. If there's slippage, she accepts it as the cost of business, not a reason to double down. Her risk per trade stays fixed. Her mind stays clear. That clarity lets her read the tape rather than her pulse. Waiting becomes strength, not paralysis. Confirmation becomes permission, not a plea. Stakes are monumentally high. 90% of retail traders fail because they scale into weakness and flee from strength. They do exactly the opposite of what successful trading requires. They add to losers hoping to get even and cut winners short, fearing they'll give back gains. This backwards approach to position sizing creates a mathematical impossibility. You cannot succeed long-term by making your losers bigger and your winners smaller. The 1/2 rule rewires this destructive pattern by forcing you to prove your thesis before committing full capital. When you internalize this approach, market noise becomes information rather than emotional torture. Your decisions sharpen when you're not drowning in oversized positions. You stop reacting to every tick and start reading structure. You stop worshiping prediction and start enforcing process. Half first, earn the rest. Freeze when confused. This becomes your mantra for capital preservation and systematic growth. Maxim to remember: half size, full clarity. Another: green pays for green, red earns nothing more. Your future self thanks your present restraint with compounding returns. Your past self tries to sabotage it with urgency and FOMO. Choose the identity that builds equity curves, not stories for social media. Across the next chapters, you'll learn the exact entry protocol that removes guesswork from your initial sizing decisions. You'll discover the pyramiding ladder that compounds winners without building sandcastles on hope. You'll master the freeze triggers that preserve capital when the tape turns uncertain, and the exit sequence that locks in gains before the market reclaims them. But this foundation changes everything. Half-size entries don't limit your upside. They protect your downside, while preserving your ability to scale into what works. Control is the only real edge you can own. FOMO is not excitement. It is unpriced risk wearing a costume of urgency. Amateurs feel the breakout starting and slam full size without a plan, mistaking being early for being smart. Then normal market noise feels like catastrophe. Fear hijacks their original thesis. They widen stops or average down, turning manageable risk into account-threatening exposure. This isn't about courage or conviction, it's about sequence and discipline. The amateur believes bigger size equals bigger profits. The professional knows that proper size equals preserved capital, and preserved capital creates the foundation for sustained profits. When you slam full size into the first hint of opportunity, you're not being aggressive, you're being reckless. Aggression requires control. Recklessness abandons it. Here's the mathematical reality that destroys accounts with mechanical precision. When you're wrong, every additional dollar compounds your loss exponentially. This isn't linear progression, it's accelerating destruction. Consider James spotting a semiconductor breakout at $45. His analysis suggests a move to $50. He calculates position size for his $100,000 account. 2,000 shares for a $10,000 position. But instead of staging his entry, he buys all 2,000 shares at $45.15, surrendering control to randomness. From the first tick, the stock immediately fades to $44.20, normal post-breakout noise that happens in 80% of legitimate breakouts. James doesn't see normal behavior. He sees $900 evaporating and his thesis under attack. The voice of desperation whispers, "Buy more at $44.20. Your average becomes $44.68. When it bounces back to $45.15, you're profitable instead of flat." So James adds another 1,000 shares at $44.20. His position is now 3,000 shares with an average cost of $44.83. But the stock continues to weaken, breaking the pivot entirely and dropping to $42.80. His loss is now $6,090 instead of the $1,900. It would have been with his original position and a proper stop. He's turned a manageable 1% loss into a devastating 6% account hit on a single idea. The mathematics get worse if he adds again. At $42.80, if James adds another 1,000 shares thinking it has to bounce, his average becomes $44.05 across 4,000 shares. If the stock drops another 10% to $38.52, not unusual for a failed breakout, his total loss becomes $22,120. He's lost over 20% of his account on one trade that was supposed to risk 1%. This is how accounts die. Not from one bad trade, but from one bad trade that becomes 4 bad trades through poor sizing discipline. Amateur identity whispers, "Be first, be big, be decisive." It equates size with conviction and entry timing with intelligence. Professional identity whispers, "Be precise, be selective, be reversible." It equates risk control with survival and confirmation with permission. Sarah spots the same type of clean pivot at $100 after a multi-week base. Volume swells on the breakout. Side-it adjust to brawn. In the next steak, amateur thinking screams, buy 1,000 shares now before it runs. Professional thinking whispers, buy 500 shares. Prove me right first. Same conviction, different sequence, radically different risk profile. Sarah buys 500 shares at $100.10, with a stop at $99.40 below the structural support that validates her breakout thesis. This gives her 70 cents of risk per share, or $350 total risk on her $100,000 account. That's 0.35% risk, well within her parameters. Price pulls back to $99.80, normal noise that happens after most breakout attempts. Weak hands who bought the initial spike get shaken out. Volume dries up temporarily as the stock digests the move. Sarah doesn't panic. She doesn't add. She waits. This is the critical moment where amateurs destroy themselves and professionals build their edge. The amateur sees the pullback as an opportunity to improve his average. The professional sees it as information, the market, testing the resolve of the breakout. When price reclaims $100.60 with expanding volume, clear evidence that demand is overwhelming, supply at higher levels, Sarah adds the second 500 shares. Her average cost across 1,000 shares becomes $100.35. But more importantly, she has earned the right to that full position through market confirmation. The tape has spoken. Volume has confirmed. The breakout has proven its legitimacy through the most reliable indicator. Price and volume action working together to create higher highs. This sequence illustrates the profound difference between hope and confirmation. The amateur hopes his analysis is right and sizes accordingly from the first tick. The professional waits for the market to confirm the analysis before committing full capital. Hope is not a strategy. Confirmation is evidence. Evidence pays. Hope costs. Protocol you can copy and implement immediately. Define 1R as your risk per trade, typically 0.5 to 1% of total equity. For a $100,000 account, 1R equals $500 to $1,000, maximum risk per idea. Your initial entry should be 0.5R at the pivotal point. This means, if your full intended risk is $1,000, your first entry should risk only $500. This isn't being conservative, it's being systematic. Stop placement follows structure, not emotions. Place your stop where the idea fails technically, not where your comfort zone ends. If you're buying a breakout above $50, your stop might be $49.40 if that's where the previous resistance level sits. Don't move it to $49.80 because losing 60 cents feels better than losing 70 cents. The market doesn't care about your feelings. It cares about structural levels where supply and demand shift meaningfully. Add only on confirmation. Higher high plus volume or clear range expansion. This isn't arbitrary. It's evidence-based. When a stock makes a higher high with volume, it's demonstrating that buyers are willing to pay increasingly higher prices with conviction. When range expansion occurs, it shows that the equilibrium between buyers and sellers has shifted decisively. These are not opinions. These are facts the tape provides. If price returns to the pivot immediately after your entry, freeze additions. Wait for real confirmation, or accept the stop. This rule prevents the amateur mistake of defending a level that the market is rejecting. When price returns quickly to your entry point, it's telling you that your timing was premature or your analysis was flawed. Don't argue with the message. Listen to it. Half-sizing creates profound psychological benefits beyond simple risk management. When you start with smaller positions, you reduce the emotional intensity of normal market fluctuations. A $300 unrealized loss feels manageable and allows clear thinking. A $1,200 unrealized loss on the same percentage move creates stress that clouds judgment and leads to poor decisions. Stress makes you reactive instead of responsive. Reactive traders lose money systematically. Responsive traders build equity curves. Think about the identity shift this creates. The amateur defines himself by being right immediately. His ego attaches to every tick. When the position moves against him, he feels personally attacked by the market. The professional defines himself by following process. His ego attaches to discipline, not outcomes. When the position moves against him initially, he sees information, not insult. Information can be processed. Insults trigger emotions that destroy capital. Half-sizing also creates optionality. With half your intended position deployed, you maintain the ability to add on strength or exit cleanly on weakness. With full size deployed immediately, you've eliminated options. You're either right or wrong with no middle ground. Markets rarely provide such binary outcomes. They provide gradations of right and wrong, early and late, strong and weak. Half-sizing lets you respond to these gradations. The mathematics of this approach favor the patient, starting with 0, 5R risk, and adding another 0, 5R on confirmation, gives you the same total exposure as going full size immediately, but with dramatically different risk characteristics. If you're wrong initially, you lose 0, 5R instead of 1R. If you're right initially but wrong about the follow-through, you still lose only 0, 5R because you never added. Only when you're right about both the initial direction and the follow-through do you achieve full 1R risk. But by then, the market has paid you to take that risk. Maxim to internalize, half size, full clarity. You reduce emotional noise by starting smaller, letting the market prove your thesis before committing full capital. Another maxim: confirmation costs nothing, but pays everything. The few ticks you might miss by waiting for confirmation pale, compared to the full losses you avoid by not sizing prematurely into uncertainty. This approach requires patience, which most traders lack. They want immediate gratification, immediate validation, immediate profits. The market punishes impatience with mathematical precision. It rewards patience with compounding returns. Choose patience. Choose process. Choose half first. Earn the rest. But what happens when the market confirms your thesis and rewards your patience? Next, the pyramiding ladder. How professionals compound winners without building sandcastles on hope, letting green pay for green while maintaining disciplined risk control. Traders crave acceleration and force it at precisely the wrong moments. They add into stalls, or worse, add to losers trying to fix their average. That's not pyramiding. That's piling risk onto uncertainty. Jesse Livermore understood this distinction with mathematical clarity. Never average a losing position. Always average a winning one. This isn't motivational speaking. It's arithmetic. When you average down, you're betting more money on a thesis the market is rejecting. When you pyramid up, you're betting more money on a thesis the market is confirming. The market speaks through price and volume. Listen to what it's saying, not what you hope it will say. The mathematics of growth work fundamentally differently than the mathematics of loss. When you're wrong, additional capital compounds your exposure to being wrong exponentially. A $10,000 position that drops 10% costs you $1,000. Double your size hoping to average down, and another 10% drop costs $3,000 total. Add more, and losses accelerate faster than position size because you're fighting the trend. When you're right, each addition compounds gains linearly while maintaining controlled risk if you follow the pyramid structure correctly. But there's critical discipline required. You add in decreasing size, and only after the market pays you to add. This isn't about greed or aggression. It's about evidence and confirmation. Green pays for green. Red earns nothing more. Amateur identity craves immediate size and immediate gratification. It whispers, if this is such a good idea, why not buy more right now? Professional identity craves systematic confirmation and systematic growth. It whispers, if this becomes a good trade, the market will pay me to increase my size. One approach fights the tape with hope. The other dances with the tape through evidence. Fighting costs money. Dancing makes money. Jake buys 500 shares at $50.10, his half-size entry following the protocol from our previous chapter. His stop sits at $49.40, below the structural support that validates his breakout thesis. The stock pushes to $51.20 over the next few sessions, confirming his initial thesis. He's up 55 cents per share, or $275 unrealized profit. His account is telling him he's right. His pulse is telling him to add more immediately. But he remembers the rule: add only on expanding strength, not on the mere fact that you're profitable. He waits. This patience separates professionals from amateurs more than any other single factor. The amateur sees profit and wants to press his advantage immediately. The professional sees profit and wants to see the market earn additional risk through clear confirmation. A surge to $51.80, with rising volume, prints a new high above the previous resistance. Now Jake adds 250 shares, half his original position size. His stop ratchets up to $50.60, protecting his initial capital plus some profit. The pyramid structure is taking shape. 500 shares at $50.10, 250 shares at $51.80. Each addition is smaller than the previous. Each addition is funded by unrealized gains from the market, confirming his thesis. The trend continues with healthy consolidation and expansion cycles. At $53.20, another volume expansion allows a final 125 share addition. Jake now owns 875 shares, with an average cost of $50.89. But more importantly, his stops have ratcheted up to protect the majority of his unrealized gains. Each addition was smaller than the previous. Each addition was triggered by market confirmation, not hope or impatience. Each addition was funded by the market, paying him to take additional risk. Contrast this systematic approach with Lisa's emotional approach to the same stock. She also bought 500 shares at $50.10. When the stock pulled back to $50.80, after reaching $51.20, she saw an opportunity to improve her average and added another 500 shares. It's cheaper, she rationalized. I'm getting a better price than my first entry. This thinking reveals the amateur mindset, focusing on entry price instead of market behavior, on cost basis instead of confirmation. Lisa is adding to weakness, not strength. She's adding at a moment when the market is rejecting higher prices, not confirming them. When the stock breaks down below $50, she's overexposed to a failing idea with 1,000 shares at an average cost of $50.45. Her risk has doubled, but her thesis is being rejected by the tape. She's fighting the market instead of following it. Fighting always costs more than following. The mathematics favor systematic pyramiding over emotional sizing decisions. Consider Marcus trading with a $2-100-$1,000 account, risking 1% per idea. His 1 R equals $2,000. Following proper pyramid structure, he enters with 0.5 R initial risk $1,000. If confirmed, he adds 0.25 R $500 additional risk, a final 0.125 R addition $250, tops the pyramid only on exceptional strength. His total maximum exposure becomes 1.75 R, but achieved through systematic confirmation rather than hope. If wrong initially, he loses 0.5 R instead of full R. If right initially but wrong about continuation, he still loses only 0.5 R, because additions never triggered. Only when right about both direction and follow-through does he achieve maximum exposure, but by then the market has paid him to take that risk. Protocol for pyramiding that removes emotion and enforces discipline. Add only in halves following this precise structure: 0.5 R initial entry, then plus 0.25 R on first confirmation, then plus 0.5 125 R maximum on second confirmation. This creates a pyramid where each level is smaller than the previous, reducing risk as you move further from your original entry point. Your total risk never exceeds 0. 175 R. But your profit potential scales with market confirmation. Trigger requirements are non-negotiable. Higher high plus volume or clear range expansion after tight consolidation. This isn't subjective interpretation, it's objective evidence. When a stock makes a higher high with volume, buyers are demonstrating willingness to pay increasingly higher prices with conviction. When range expansion occurs after consolidation, equilibrium between supply and demand has shifted decisively in favor of demand. These are facts, not opinions. Base your additions on facts. Never add to a loser. If price is below your last addition, freeze all additional risk. This rule prevents the amateur mistake of defending a position that the market is rejecting. When price falls below your most recent add, the market is telling you that your timing was premature or your thesis is flawed. Don't argue with the message. Accept it and preserve capital for clearer opportunities. Ratchet stops up with each addition to protect the pyramid structure. This isn't about locking in profits, it's about preventing round trips that destroy psychological capital along with financial capital. As you add to winning positions, move your stops up to protect the majority of unrealized gains. The exact level depends on market structure, but the principle remains constant. Protect what the market has given you. If momentum stalls narrow ranges, dying volume, sideways grinding action do nothing. Stalling momentum is the market's way of saying, pause. It's not saying, add more or get out immediately. It's saying, wait for the next clear signal. Professionals wait. Amateurs force action during unclear periods and pay for that impatience with poor results. The psychological benefits of proper pyramiding extend beyond simple profit maximization. When you add to winners systematically, you're reinforcing positive behaviors and positive outcomes. Your brain begins to associate patience with profits, confirmation with permission, and discipline with success. When you add to losers or add without confirmation, you reinforce negative patterns that compound into systematic failure. Pyramiding also creates powerful risk-adjusted returns through position sizing discipline, not just stock selection. Your winners become bigger than your losers through systematic response to market confirmation. This is how small edges compound into large returns over time, not through prediction, but through systematic response to what the market provides. Maxim to internalize: green pays for green. Your winners earn their own size increases through market confirmation. Another maxim: size follows strength, not hope. Let the tape tell you when to add, not your emotions or your account balance. The market rewards those who listen to its signals and punishes those who impose their will upon it. But what happens when the tape turns uncertain, when confirmation fails repeatedly, or when your read is off rhythm? Next, the freeze triggers that separate survival from destruction. The discipline of doing nothing, when nothing is the most profitable action. Losses rarely explode because your ideas are terrible. They explode because you accelerate after impact. After 2 quick stops, amateurs get emotional and swing harder. They try to win back lost time and money with bigger size and looser discipline. This is the gambler's fallacy, wearing a trader's costume, the belief that past losses somehow entitle you to future wins. Professionals recognize when the tape turns wide and loose, when confirmation repeatedly fails, or when their read is off rhythm with market reality. Freeze isn't failure, it's capital defense. It's the discipline to stop digging when you find yourself in a hole. The market doesn't care about your schedule, your monthly targets, or your need to feel productive. It cares about supply and demand. And when those signals become unclear, the professional steps aside. Amateur identity equates activity with progress. Professional identity equates selectivity with survival. One approach treats markets like a video game where more attempts equal higher scores. The other treats them like surgery where precision matters more than speed. Here's the paradox most traders never grasp. Sometimes the most profitable action is no action at all. This concept violates every instinct bred into competitive people. We're taught that effort equals results, that persistence conquers resistance, that trying harder solves problems. But markets operate by different rules entirely. When your conviction isn't absolute, when the market speaks in whispers rather than shouts, the professional freezes. This isn't fear-based inaction, it's strategic patience, a deliberate choice to preserve capital for clearer opportunities. Fear paralyzes you at the wrong moments. Strategy pauses you at the right moments. One destroys accounts through inaction when you should act. The other preserves accounts through inaction when action destroys capital. The amateur asks, "How can I trade my way out of this hole?" The professional asks, "How can I preserve capital for the next clear opportunity?" Waiting becomes a position. Patience becomes risk management. Time becomes a weapon against your own impulses. Maria attempts 2 breakout trades following her systematic plan exactly. Her entries are precise at pivotal points. Her stops are structural below support levels. Yet both positions stop out quickly. No follow-through. Sloppy spreads. Inconsistent. Volume patterns. The setups looked perfect on paper, but the market rejected them with authority. Amateur Maria sees 2 losses as a challenge to her competence and analysis. She pushes a 3rd time immediately, desperate to get even, and prove she can read the tape correctly. Her position size increases because she's due for a winner. Her selectivity decreases because she needs to recover losses quickly. This emotional drive overrides systematic analysis, pushing her into increasingly hostile conditions. Professional Maria sees 2 losses as information about current market conditions, not personal failure. She freezes immediately after the 2nd stop. She sets a timer for 1 full session and switches to pure observation mode. No new orders, no position additions, no attempts to force profits from unclear conditions. She notices failed breakouts occurring market-wide, not just in her selected stocks. Rising volatility is creating false signals across multiple sectors. Spreads are widening beyond normal parameters. Volume patterns are becoming inconsistent and unreliable. The tape is speaking, but it's saying wait rather than trade. She acknowledges that her edge isn't present in current conditions. She accepts the 2 small losses as tuition for market education. The next day after her disciplined observation period, conditions begin to tighten significantly. Spreads narrow to normal levels. Volume patterns become more predictable and aligned. Breakouts begin following through with authority instead of failing immediately. Clear trends emerge with institutional sponsorship. Maria's 3rd attempt works precisely because she waited for the market to clarify its intentions rather than forcing her intentions onto an uncooperative market. Same trader, same systematic strategy, different timing sequence. She preserved both her capital and her psychological edge through strategic patience. Install these freeze triggers before the opening bell, not after. Emotional damage occurs. First, 2 consecutive stops in the same idea or sector within 1 session means freeze that concept for the entire day. When the same setup fails twice quickly, the market is rejecting that pattern with clear authority. Don't argue with the rejection. Accept it and preserve capital. Second, hit your daily loss limit of -2R, and you stop all new risk immediately. This isn't negotiable or flexible. Protect your mind as aggressively as you protect your money. Most traders set daily limits but ignore them when emotions spike. The limit exists to prevent small problems from becoming account-threatening disasters. Third, repeated confirmation failure requires standing down for 1 complete bar cycle minimum. When volume doesn't appear after breakouts, when ranges narrow immediately after expansion, or when price consistently returns to pivot points, the market is repeatedly failing to confirm your thesis. This isn't conspiracy, it's clear communication. Fourth, wide and loose tape conditions demand immediate size reduction or complete withdrawal. Large wicks on candles, inconsistent gaps, erratic price action, or widening spreads indicate lack of institutional sponsorship and increased retail chop. Your systematic edge depends on clear signals, Messy signals require reduced participation or complete abstinence. Fifth, psychological warning signs require immediate freeze protocols. The urge to win it back, bargaining with stop losses, or hands hovering over the mouse seeking any excuse to enter trades are internal alarms. These aren't market signals, they're emotional hijack warnings indicating compromised judgment. When you notice these patterns, freeze all activity immediately. Take a walk, practice breathing exercises, or remove yourself from the trading platform entirely until rational thought returns. Your physiology often drives your next click before your brain processes the decision. What freeze means practically: no new orders for a defined time period, tighten existing stops to structural levels, switch to observation mode, and mark pivotal points for future reference. This isn't vacation, it's reconnaissance without risk. Use freeze periods to study market behavior without the pressure of active exposure. Journal what the tape is communicating in plain language, rather than rationalizing outcomes or fighting reality. Often the best trades come from patterns observed during freeze periods. When you're studying without the emotional pressure of having capital at risk, consider David trading with a $100,000 account using proper risk management. He hits 2 consecutive stops, losing 1 R total $1,000. Amateur David immediately attempts a third trade to get back to even, risking another full R. If that fails, he's down 3 R and feeling desperate pressure to recover. Professional David freezes after -2 R, preserving 98% of his capital for clearer opportunities. When market clarity returns, he has significantly more capital available to deploy systematically. The mathematics favor patience over persistence when conditions turn unclear. Freezing prevents the psychological damage of consecutive losses, compounding into systematic failure patterns. Each loss creates emotional residue that clouds judgment for subsequent decisions. When you freeze after defined triggers, you break the destructive cycle of emotional decision-making that transforms small, manageable losses into large, account-damaging disasters. You give yourself processing time to analyze what happened objectively, rather than reactively. This self-awareness separates professional behavior from amateur impulses consistently. The discipline of freezing requires active ego management and identity control. Your ego wants to prove it can overcome any market condition through increased effort and determination. Your account needs you to admit when conditions don't. Favor your systematic approach and step aside accordingly. Ego preservation costs money systematically. Capital preservation makes money systematically. Choose capital over ego every single time without exception. Professional identity treats freeze periods as investments in future profitability rather than admissions of defeat or weakness. Pattern interrupts matter because your physiology often drives your next decision before rational thought engages. When breathing becomes shallow and shoulders tense, your brain demands immediate resolution through action. Trade the internal sensor, not the external story. If you catch yourself scanning profit and loss statements obsessively, close the display. If hands hover over the mouse, stand up and walk away. If sentences begin with "I just need," freeze immediately and completely. Maxim to internalize permanently. When confused, reduce. When scared, freeze. Confusion indicates lack of clarity about market direction or analytical. Accuracy: reduce position sizes to match reduced conviction levels. Fear indicates emotional compromise that clouds systematic judgment. Freeze all activity until rational thought returns completely. Another essential maxim: sitting is a position. Waiting for clear opportunities isn't passive behavior, it's active capital preservation that funds future systematic execution when edge returns clearly. But what happens when you followed the system perfectly and generated significant wins? Success creates dangerous psychological challenges that destroy more accounts than failure does. Next, the halfback failsafe that prevents giving back hard-earned gains when momentum shifts, and the post-win protocols that manage overconfidence psychology after large profits. After big wins, fear flips to greed with surgical precision. You feel invincible, untouchable, like you finally cracked the market's code permanently. That's exactly when amateurs double blindly, loosen stops, and give back a week's gains in an hour. Success intoxicates judgment more effectively than alcohol impairs coordination. The dopamine flood from winning convinces your brain that recent success guarantees future success, that your analysis has suddenly become infallible, that risk management rules no longer apply to someone of your obvious skill. Professionals recognize this psychological trap and deploy two systematic safeguards: the halfback rule and the post-win half-life. These aren't suggestions, they're mandatory circuit breakers designed to protect you from your own success-drunk decision-making. Amateur identity treats big wins as permission to risk bigger. Professional identity treats big wins as warnings to risk smaller. The market rewards disciplined deceleration and punishes euphoric acceleration with mathematical consistency. The cruelest irony in trading: your biggest enemy after a big win is yourself. Losses teach humility and force risk management through pain. Wins breed overconfidence and encourage recklessness through pleasure. Success becomes more dangerous than failure because it feels so right when it's actually setting you up for catastrophic wrong. The mathematical reality is unforgiving. Overconfidence leads to oversized positions, loose stop management, and the fatal belief that your recent performance predicts future performance. The market has a way of humbling the proud, taking back gains from those who mistake temporary success for permanent skill. This isn't personal vindictiveness, it's statistical regression combined with behavioral psychology. Hot streaks end. Overconfident behavior during hot streaks creates the conditions for cold streaks to be account-threatening rather than manageable. Before your big win, you followed systematic rules precisely. You sized conservatively, placed stops structurally, waited for confirmation. Those disciplines created the win. After the win, your brain attributes success to intelligence rather than process, shifting from systematic response to predictive arrogance. This shift destroys more accounts than bad analysis ever could. Omar trades a clean breakout campaign from $40 to $46 using proper pyramiding techniques developed through painful experience. He started with 500 shares at $40.25, his half-size entry at the pivotal breakout point. When volume confirmed the move with expansion to $41.80, he added 250 shares, half his original position. Another surge to $44.20, with institutional sponsorship, allowed his final addition of 125 shares, each layer smaller than the previous. His pyramid structure generated plus 3R in unrealized gains, $3,000 on his $100,000 account. The mathematics are beautiful. Disciplined entries, systematic additions, ratcheting stops protecting each level. He feels the intoxicating rush of being right, and the dangerous urge to press his advantage as momentum stalls near $46.20. His brain whispers seductive lies. You're on fire. Double down. This thing's going to 60. You've got the magic touch today. The amateur voice grows louder with each winning trade, promising that more size equals more profits, that his recent success proves his prediction abilities. But Omar remembers the safeguards drilled into his systematic approach through previous painful lessons. He watches price action with disciplined attention rather than emotional attachment. Price pulls back from $46.20 to $44.80, and Omar immediately calculates the significance. The last meaningful impulse ran from $43.60 to $46.20, a $2.60 thrust higher. The pullback to $44.80 represents a $1.40 retracement. Simple division: $1.40 divided by $2.60 equals 54%. Essentially the halfback level that signals potential momentum exhaustion. This isn't opinion or interpretation, it's mathematical measurement of market behavior. The halfback signal warns that the easy money phase might be ending, that supply and demand are reaching a new equilibrium that may not favor continued upward movement. Instead of adding more shares or loosening his stops to give the position room to breathe, Omar stops all additions immediately and tightens his stop under the last higher low at $44.20. No new risk until clear confirmation of renewed strength returns. He protects most of his 3R gain, avoiding the round trip that catches the overeager and overconfident, who mistake temporary success for permanent edge. The halfback rule operates on both technical and psychological levels with mathematical precision. Technically, when price gives back approximately 50% of its last impulse without immediate reclaim, it signals potential momentum shift or exhaustion. The buyers who drove the last leg up are no longer overwhelming sellers with the same conviction. Supply and demand are reaching equilibrium that requires proof of renewed sponsorship before additional risk makes sense. Strong moves typically retrace 1/3 quickly, then resume. Tired moves retrace half, hesitate, and often fail. The midpoint reveals institutional sponsorship levels. If smart money still supports the advance, price reclaims the halfback level swiftly with volume. If institutions are distributing or stepping aside, price hovers, volume diminishes, and range deteriorates. Your job isn't predicting which scenario unfolds, it's responding systematically to what actually happens. Psychologically, the halfback rule forces acknowledgement that your winning trade might be ending and prepares your mind for profit protection rather than profit expansion. It breaks the dangerous cycle of assuming recent success guarantees continued success. Protocol for implementing the halfback rule. Measure each significant impulse as it develops, marking the clear beginning and ending points. When price retraces approximately 50% of that impulse, immediately halt all position additions and consider scaling out 25 to 50% of your holdings. This isn't about predicting reversal, it's about acknowledging momentum change and responding with capital preservation. Tighten stops to protect the majority of unrealized gains, typically under the most recent structural support level. Set alerts for potential re-entry above the failed retracement high if institutional sponsorship returns with volume confirmation. This systematic response removes emotion from crucial decisions and prevents the amateur mistake of hoping through deteriorating conditions. The post-win half-life protocol provides essential psychological protection after significant success. After wins of +3R or more, trade half your normal size for the next 3 trades minimum. This isn't punishment, it's systematic ego management and psychological recalibration. Large wins alter brain chemistry, creating dangerous overconfidence that leads to oversized bets on marginal setups. Your perception of risk becomes distorted by recent success, making normal-sized positions feel conservative and encouraging reckless size increases. Half-sizing for 3 trades forces gradual confidence rebuilding rather than risking psychological and financial capital on the next idea. It acknowledges that your best trading often comes from systematic process, not emotional momentum from recent wins. This cooling-off period prevents the common pattern where spectacular success immediately precedes spectacular failure through overconfidence-driven poor decisions. The complete protection framework integrates multiple safeguards against success-induced destruction. Implement a profit-taking ladder that scales partial profits into strength, while trailing stops under swing structure. Take 20 to 25% profits at first extension targets, another portion at second targets, then trail the remainder with stops that protect the majority of gains. This approach captures most profitable moves, while avoiding the all-or-nothing mentality that creates devastating round trips. Enforce the daily green rule. After +3R days, stop all new risk entirely. Quit while sharp preserves edge better than one more trade destroys it. Your mental acuity has limits,